Welcome to the Traders University Contracts for Difference Tour. Now, let's get started. Contracts for Difference, or CFDs for short, are used by investors as a proxy for stock transactions. This tour is designed to help you better understand several efficiencies that arise from trading them instead of using physical shares in the underlying company. At the end of this tour, you will be more familiar with the distinctions in tax treatment, margin, order routing, and commissions due on CFDs compared to stock or share trading. Investors considering using CFDs should understand the risks of using leveraged investments. What is a CFD? A CFD is an agreement to exchange the difference between the opening and closing value of a share, index, or commodity. The difference is based on the change in price of the underlying equity or index over the time the CFD remains open. Mark-to-market profit or loss is reflected in the customer's account each day and therefore could change the value of funds available for trading use each day. A contract for difference is an agreement between the client and interactive brokers designed to match as perfectly as possible the performance of the underlying asset. Here are some key concepts behind contracts for difference. CFDs attempt to mirror the performance of a stock, including dividends and corporate actions. CFDs may in some places be exempt from stamp duty. CFDs offer the benefits of derivatives, but without some of the drawbacks typically associated with derivatives. CFDs offer leverage, but also allow investors to make smaller transactions of as little as one individual share. CFDs don't expire and therefore don't lose time value, which means the premium doesn't erode. CFDs don't need to be rolled over like a futures contract. Initial positions in CFDs can be taken to position for anticipated increases in the underlying, or they can be taken to position for an expected fall in the value of the underlying. Stamp duty was introduced in the UK on share transactions in 1986 and in part is responsible for the emergence of the market for contracts for difference. And while there are no guarantees that CFDs won't ever become subject to taxation, industry observers say that the government would be taking a step backwards if it moved to encompass this market. To do so might harm the financial services industry, claim onlookers. UK SDRT, or stamp tax, is applicable on existing shares in a UK company or a company with a share registration in the UK. Stamp duty is one of several reasons why investors prefer contracts for difference over buying or selling shares of a listed company. On a £10,000 transaction, an investor faces a £50 levy paid directly from the settlement amount of the transaction and is paid directly to HM Treasury. Investors can establish long or short positions using CFDs, and they are designed to exactly match the price performance of the underlying shares. Another advantage is that dealing in CFDs allows investors to more efficiently leverage their capital. We will address leverage requirements shortly. When buying or selling CFDs representing an underlying share price, the reference quote is taken directly from that of the underlying. An investor anticipating a share price increase might buy CFDs at the outset representing an economic interest in the company's share price performance. Assuming the investor is correct and the share price rises as expected, the investor could then sell the CFDs to close the position because the reference price moves in line with the share price. The investor would therefore have performed as well as had he or she purchased shares in the company. The term contract for difference comes from the fact that you make or lose the difference between your opening price and the closing price. As a buyer of contracts, you want the distance to widen such that your closing price is higher than your purchase price. On the other hand, sellers of CFDs want to sell contracts at a relatively high price and repurchase them in the event of a decline in the share price. Here's a look at the costs associated with buying CFDs representing £300,000. In this example, an investor buys CFDs using a 10-to-1 ratio using a nominal amount of £30,000. Do note that when using leverage, you are being charged interest on the face value or notional amount of what you are buying or selling, the leveraged amount. Your account is debited per day on this amount at IB's low interest charges, which are clearly displayed under the Costs and Financing Charges area of the website. These charges are specific to CFDs and are applied in a blended fashion, meaning that you pay interest according to each displayed tier. Here, we have calculated interest applicable at Tier 1 and Tier 2, and the position is assumed to be held over a 30-day period. You can see the monthly payable interest rate costs according to Tier 1 and 2 applied rates and how much it will cost to run a trade of this size under similar conditions. Note that what you're seeing here has nothing to do with the performance of the trade itself. Statement profit and loss is considered separately. Interactive Brokers offers trading in a broad variety of asset classes around the world, including stocks, options, futures, forex, bonds, funds, spot gold, and now CFDs. Our global product offering is presented at low commissions to our customers. Commission on CFDs is subject to a minimum £5 per transaction, but is set on a trade value basis and starts at an extremely low 0.08%. A trade involving £10,000 face value would incur a commission of £8. Customers trading larger volumes might benefit from our sliding scale fee structure. The initial breakpoint comes in at volumes above £1 million per month, on which fees are 0.06%, while volumes between £50 to £100 million monthly pay 0.03% of trade value, subject to a minimum charge of £2.50 per transaction. As a pioneer in trading technology, Interactive Brokers makes available to its customers proprietary smart routing software. whose purpose is to achieve the best overall cost for marketable orders. IB Smart Routing Technology looks at the best quotes across competing exchanges, including the London Stock Exchange, to determine its reference value for quoting a CFD to its clients. That reference rate might be based upon the best bid at one venue and the best ask price at a competing venue. When one exchange offers a price advantage over another, it is the role of our smart router to pick it up, ensuring that the customer is provided a reference rate at least as good or better than what you can see at the LSE. Note also that IB never widens the quote outside of what investors can see at the exchanges. In addition, customers are faced with a variety of order types that could improve the price at which the trade is executed. For example, under certain circumstances, clients using limit orders could possibly achieve a better priced fill compared to the best available screen quote. To just about all intents and purposes, trading in CFDs mirrors share trading. Efficiencies are apparent through lower tax transaction costs in certain areas, reasonable leverage, and more efficient commissions. For existing IB customers wanting to trade CFDs, access appropriate market data in the account management area of your account or through the IB website.